Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. I'm joined today by Zach LeMaster. He's the founder and CEO of Rent to Retirement. Zach, thank you so much for joining.
Dalton, it's a pleasure to be here. I know we're going to talk about a lot of exciting stuff as we're moving into the new year, and excited to be here.
Yeah, this is one of the first episodes of the year, and good to sit down with you and talk to me about Rent to Retirement. I don't think you could come up with a better name. How'd you lock that name down? And give me some of the backstory of what you all do at RTR.
Yeah, absolutely. It's a little bit of a tongue twister, but very true to the name in terms of what we try to accomplish for both ourselves and our clients. Very much building a rental portfolio to provide some level of retirement for investors, really whatever position they're in. If they're a newer investor, if they're looking to scale and diversify, whatever the case is. Real estate has really been, for us, Dalton, a game changer with our own life. I actually have a medical background working as an optometrist, as does my wife. We met in school in Oregon many years ago. I went into the Air Force since I was on scholarship for 7 years and spent 7 years in the Air Force as an OD, and then moved to Colorado after I exited the Air Force to work as a full-time optometrist here running private practices. During that entire time, we invested in rental real estate. Starting very slow. Even the first house we purchased was just a duplex, rented out half, lived in half, ended up trading that up, doing it, we didn't have to do a 1031 on that one, but it ended up just scaling up every single year. Every single year since that first duplex, we bought more and more real estate, and then strategically started to invest in different areas where we can maximize our returns, not just being focused on our local market, wherever that was. And then we got to the point where we were able to replace our active income with real estate investing. That allowed us to, retire essentially from the healthcare career fields and take on a full-time investor kind of position. And so a lot of our friends and family were looking at that saying, that looks very interesting. We want to participate in real estate. We love the benefits of real estate ownership. We don't know where to start. How do you invest out of state? And hence the, Rent to Retirement was born. We're assisting investors in building passive income portfolios in the markets that offer the best returns. We're a turnkey company, meaning we essentially sell investment properties to clients that are fully renovated or new construction, which we work a lot with Lima One on, to set themselves up to be in a scenario to obtain some sort of financial independence or retirement picture. So that's kind of a quick backstory on myself.
Yeah, I want to unpack that last part a little bit. The space of real estate investing is incredibly crowded with educators, right? For all different types. You have on one end of the spectrum, you could say masterminds, kind of the quote unquote more elite education groups, peer-to-peer type groups. And then you have on the other end, folks looking to get into real estate investing for the first time. You have kind of local meetups. Talk me through your competitive advantage a little bit, because Rent to Retirement I don't see it, and correct me if I'm wrong, I don't see it as just an education piece. It really is kind of a full service game plan maker. How would you describe it?
Yeah, absolutely. And we work in the turnkey space. Turnkey is a very broad term that people have many different definitions of, and so we always want to clearly define that. And really our competitive advantage, Dalton, is we're not just selling properties to clients. We're helping them build a comprehensive business plan, because that's what you're doing when you're investing in real estate. You are building a business, and there's ancillary things that come along with that to ensure that you're going to be successful over time. You got to make sure you have the best financing options in place, ensure you have the right CPA and attorney to make sure you have your legal structure set up, you're doing taxes appropriately. In my opinion, the best benefit of investing in real estate in general is the tax benefits. It's like the tax code is exclusively written for real estate investors. So, our approach to assisting investors is to build a comprehensive business model and assist them in accomplishing their goals over time and stay engaged with those clients. Everyone is in a different position with where they're at in their investing career. Some people are just getting started. Some people have a large portfolio and they're looking to diversify, exchange up, whatever the case is. We have built an entire network just from being successful investors ourselves to open that up to our clients. So yes, we're selling turnkey investments to people that want to be, a passive investor or diversify into the different markets that offer the best returns. But there's a lot that goes into that from a coaching and mentorship standpoint. We, as you mentioned, we see a lot of people in the education and these gurus out there that are offering seminars and charging people exorbitant amounts to do that. Well, in my personal opinion, is true education comes from hand-on experience and actually investing. You can research and read all day long, but actually having that core group, that network of people, and surrounding yourself with people that are already successful with where you want to be is the best place, in my opinion, to accomplish the success. You don't need to spend high dollar amounts of money on education when you could easily work with a mentor or a team that assists you in actually building your own portfolio and simply learn over time. So I think that's our competitive advantage, at least in the turnkey space, is a simple fact that we obviously have our strategy to identify the markets that offer the best cash flow, equity, and appreciation, but also coupling that with building an individual investment plan for the client, for our investor, to help them be successful over time.
Yeah, I think that's a big differentiator, and you hit the nail on the head in my, call it personal opinion, that the hands-on learning piece, right? For this, you could sit in a classroom for hours and hours and days and weeks and months and years working on the spreadsheets and talking to folks in the space, but to actually learn this space, you have to do deals. You have to acquire real estate to be a real estate investor, and everything outside of that is just real estate investor. So that's a big differentiator on the turnkey space. And I want to talk about rental income for a minute, right? So HPA, home price appreciation, that has been up and to the right for the last 18, 24, 36, for really the last few years. The last year and a half, it's been astronomical. But one thing I think folks often forget, I think the home price appreciation piece buys the headline space a lot of the time, but rents have surged to a greater degree in a lot of cases. And do you see any issues with the pace at which rents have throttled up over the last 18 months?
I think it's hard to make a general assumption across the country because we really would need to look on a microeconomic scale and evaluate each market individually. Absolutely, there's an affordability standpoint in some parts of the country where rents are getting out of hand, and you've actually seen the government come in and initiate rent control, which is a very challenging thing from an investor perspective, where you're capped on what you can charge, and having the additional regulation that is imposed on the property owner. A lot of the parts of the country that we focus on are your middle class rents. This is usually your $800 to $1,200 rent range. This is kind of your bread and butter investment housing that is always going to have demand. You're always going to have affordability in those price points as well. That gives us a lot of, we're not doing these high-end luxury houses where I do think, to your point, there absolutely will be, an affordability standpoint. Same thing with appreciation. We've been riding this train for a long time, and people have been talking about a potential correction or, whatever the case is. And I think that will happen at some point, probably. I mean, everyone wants to compare to 2008. In no way, shape, or form are we in any sort of similar sort of setting. But I think it's going to be very much market by market. In certain parts of the country, you may see some areas where appreciation and rental increases are either capped or we start to see a slowdown at some point in time. The areas that we focus on, all cash flow. And that's really the core message. I mean, we want to be in areas that have things like landlord-friendly legislation, low taxes, population and economic growth. But fundamentally speaking, our main core criteria is ensuring the property's cash flow. Because that way you have, if you have a tenant in your property paying rent, it's a sustainable property. The market can really do whatever it wants in terms of values. And, we know that all real estate goes up over time. But I think that's how you create a sustainable business model, and focusing in different sectors of these markets where you do see consistent affordability for rents.
Yeah. So what markets have you excited right now?
There's a lot of different markets for different reasons. Kind of the markets that we focus on are a lot of the Midwest and Southeast. Mm-hmm. These would be the markets that fit our criteria we talked about previously from a tax and legislation standpoint. Also, where we see high rent to price ratios to be able to actually have positive cash flow. There's a lot of areas that you simply can't cash flow. East and West Coast being a lot of those. So we invest heavily in Ohio, Missouri, Indiana. We do a lot of new construction in areas that still have affordability but are growing dramatically in terms of price points. This would be more of the Southeast, Florida being one of the big states. I mean, if you just look at population trends over this past couple of years, everyone's moving to Texas and Florida, Texas being the front runner. However, property taxes are going up dramatically year after year in Texas, which makes it a challenge to actually cash flow. So we want to be in the path of progress and be in those areas. Florida is an area where you have 1,000 people a day moving. All the builders combined cannot keep up with the housing demand. We right now are seeing the houses that are on market for both rental and resale are we have the shortest amount of inventory that we've ever seen in history, as well as the shortest amount of time on market for rentals and resales. And that's just simply a supply and demand. There's so many people moving there. And there's a handful of different reasons for that. I mean, you have the sunshine and the good weather, and coastal access. You have general affordability, at least for right now at this point in time. There's no state income tax, landlord-friendly legislation. So a lot of what we do is new construction in Florida. But in general, we're always looking for the markets that meet our standard criteria we talked about.
Yeah, is picking on Florida a little bit. What markets in Florida, like Florida, like California, like Texas, you have so many markets within that state. Are there any that are kind of on the opposite end of the trend that you're shying away from? Or is it kind of the whole state en masse is just on fire?
I think, to be quite honest, you could throw a dart at the map of Florida and probably be okay if you're investing. However, we do see certain areas like Orlando, for instance, that the prices are starting to get rather aggressive and kind of hard to cash flow. But Florida's a big state.
Yeah.
There's a lot of land and real estate that you can participate in to be successful. Specifically with us, we're focusing on Southwest Florida. I mean, a lot of the new construction stuff that you guys are actually funding for us to build. Just to run through actual numbers, we're building these properties below $300,000. They're renting out between $2,300 to $2,400 a month. I mean, that's going to be a double-digit cash flow return if you have long-term debt with those kind of numbers. But the big key is those properties are appraising usually between $60,000 to $120,000 more than we're building them for. So I mean, there's just so much growth, and I think that if you're looking at all those metrics, being in areas that you're still building below the median house price point, rents are still in the range that are going to allow you to cash flow, and you still have that kind of demand and appreciation to give you immediate equity, that creates a win-win scenario all around.
Yeah, pulling back a little bit and just talking about kind of the U.S. as moving more and more towards kind of that renter nation concept. The traditional American dream, I think, is on the definition of the traditional American dream, right? That SFR home, white picket fence story that everybody knows by heart. A little shaky footing, not necessarily a good thing or a bad thing, but I think you look at other countries like you look at England, like the UK, that has relatively higher rental rate than the US and other developed countries. And what do you think about the direction that the country's heading from a renter standpoint? Do you think that what pros and cons do you see, assuming that kind of the rental growth continues? And build to rent is another thing that you touched on, that in the last few years in our space on the private lending side of the business, just money has been pouring into from the capital market side of the fence, and by default from the lending side of the fence, you have build to rent communities popping up all over the place. Whereas somebody would just build a house to rent out, you have entire communities, hundreds of SFRs that are purpose built for this. So, a very long-winded question there, but to circle back to it, does everything seem good and fine with that direction, or do we think there's kind of some downsides to that home ownership rate potentially decreasing over the next 5, 10, 20, 50 years?
Well, from an investor perspective, it's a good thing,
Yeah.
right? When you have an increase in renter demographics, and it's interesting because right now, Dalton, we're actually seeing it on both sides of the age difference. So we're seeing your younger generations that are, it's less of a priority for them to own a house. They don't want to be locked down in a certain location. We're seeing more people working from home, moving, at a higher rate, and not transitioning to different markets, and at a faster rate versus I'm going to buy a house and this is where I'm going to live for 20 plus years. That's kind of an old mindset. People want to have access to amenities. The younger generations want to have access to certain things within the city that attract to them, and because of that, they just don't have the same goals that we did as a country. But buying the single family house with the white picket fence, I think that is an outdated thing. So we see rental increasing. That's causing higher rental demand. Investors are conscious of this and doing more of building the actual communities, building the rental properties that we're participating in. Addition to that, we're seeing millennials and younger generations actually investing in investment property before they own their own property, and so that's a good thing to see. Same thing with baby boomers. We're seeing a lot of the older generations that they have owned a house before, and in their point in their life, they don't want to anymore. They want to have the convenience and accessibility of having a rental property, or potentially even a couple rentals or options to migrate around the country. So I mean, this is something that we're definitely seeing, and it's happening now. From an investor perspective, this is something to be conscious of what sort of things do you need in your rental property, what sort of amenities and areas are people migrating to and looking to, especially as they're working more remotely. We've seen a lot of this is in causing increased rental demand in really all locations.
Yeah, and you touched on supply demand earlier, and that's not something from a home buyer perspective. That supply piece is not going to be quote unquote fixed overnight, or over the next 12 months, or probably even 24 months, right? And especially you look at, I think even the most optimistic estimate that hits is in the 3+ year mark, right? I mean, you look at even supply chain issues that we're still having today, that for the foreseeable future, I mentioned this very, very early on in the podcast, but I was out at a conference in Vegas talking with a pretty big vendor for home builders, and they said their projections for materials were down 30% this year, and they were marking it for the same projection for 2022. Just not expecting things to get better in what is now this year, 2022. So that assuming that that's spot on, you're not going to have a normalized supply chain until at the earliest the tail end of 2022, which just means that the supply demand imbalance, and then you have the sheer number, right? Anywhere from I've seen as low as 1.5, 1.8 million up to many millions of homes of a deficit that we have. So it seems like there's the rental piece is about as true of a market fluctuation as there is. It's pretty simple on its head, it seems. No?
That's kind of a loaded question. There's kind of a portion to talk about, but there's so much that's dynamic right now. These past few years, talking about COVID and supply chain issues, there's a lot that is concerning, but no doubt about it, we have in most markets, and the markets that we focus on, way more for housing demand than we can supply, than all the builders and people doing rental properties can supply collectively. Again, that's a good thing from an investor perspective, because that means you're going to have low vacancies. You're going to see increasing rent amounts over time. And those are the areas that you want to be investing in the path of progress. But it's not getting any better. We've seen over this past year, you need to be, I guess, agile and be able to strategically plan for how you're going to adapt to the changing and always changing circumstances. We've seen some of our builder colleagues and competitors just stop building until there was some normalization and some of the materials. One thing that we did is actually pre-order a lot of stuff and have involvement in concrete companies and lumber companies. We have some lots that we purchased that are just basically fill yards for certain materials, And so there's certain things you can do to make sure that you're staying up to speed with what that demand is.
Are you seeing, and have you seen, is it more market driven or is it more purely product driven in terms of the supplies?
I would say both. I mean, obviously there's the inherent simple fact that people need a place to live, whether they're buying or renting, and there's just not that many options. Like for instance, if we focus on Southwest Florida, what we're seeing is a lot of people are actually going under contract to purchase these if we're building a house for retail sale once the slab is poured. And you have multiple competitive cash offers for those purchases because usually these are people that are leaving one of these really expensive coastal markets and they just sold their 3-2 1950s house for 1.4 million. They can come and buy a much larger house in Florida for a fraction of that cost. So there's that aspect of it, and then you couple that with the supply chain issues and what we've seen, especially with lumber and certain things over this past year. It's been a challenge and it's continuing, but you have to adapt and have a plan for it. And I think if you're able to figure it out, this is a very attractive time to be in the rental space, to be in the building space, especially.
Yeah, that migration from high cost of living to medium cost of living, that's big. We're, as I said, I'm 2.5 hours away from Atlanta, which is kind of where my day job, Lemoine Capital, where our company was founded, and we still have a really good presence and monthly and annual loan production there, really strong foothold. And talking with folks there, they say that is a big driver of home prices. Not only do you have the supply issue, which is most everywhere in the country, but you have a large number of people leaving these high cost of living markets, moving into, like you talked about, the Southeast, more affordable regions, but relatively speaking, medium cost of living compared to a Manhattan or San Francisco or Austin, Texas, somewhere like that. And that uh, and then you look at moves from Northeast to Florida. That's been another big one. So I think those are gonna that migration is gonna keep happening, especially with the fact that work from home is here to stay to a much bigger degree than it was pre-pandemic.
Yeah, if there's anything that, I mean, big kind of shift in the workplace market that we've seen with COVID, it's exactly that point, Dalton, is the simple fact that businesses are finding out that people can actually be more efficient and they can cut a lot of overhead by having people work at home,
Mhm.
and really adapting to how are you going to do that. Even just Zoom meetings are so much more prevalent right now. We should have invested in Zoom stock or something, back in the day. But so that's a big piece of it. And also I think taxes are another driving factor. You have some of these areas where the state income tax is just climbing, and you couple that with the taxes on all consumer goods in that area, as well as the national tax, which taxes aren't going down. It's just a simple fact of life. And so you can move to a state that has zero income tax and also has more affordability for cost of living while having your high paying job in a different part of the country. It just makes sense.
Yeah. I want to switch gears with the little bit of time we have left. Can I pick your brain about self-directed IRAs for a minute?
Yeah, absolutely. We have a lot of people that invest in real estate through self-directing their retirement or doing a solo 401k. And I think it's an exceptional way to add a little bit of diversity and participate in real estate through a retirement vehicle.
Yeah, I first learned about this. I started at Lemoine Capital 6 weeks after graduating college as an underwriter in the long-term finance department. So I was underwriting people and property or businesses and property for 30-year rental debt, and closed our first. I underwrote and closed our first loan that went to an SDIRA. And want to hear from you a little bit. I know there's some looming potential regulation changes, but first, just what's the explain it to me like I'm five difference of using an SDIRA versus a solo 401k or a 401k compared to just an off the shelf entity, an LLC or something that's usually the normal MO for a real estate investor.
Absolutely. So the big benefit, just to kind of build this from the ground up. The big benefit of using a retirement vehicle or establishing one of these, taking an IRA or your traditional 401k and moving it into, just reclassifying it really is what it is, moving it into a self-directed account or a solo 401k account. You work with a custodian to assist you with doing this. And so there's professionals that will evaluate your situation and tell you the necessary paperwork and steps you have to do to basically transition the account. And all that does is allow you to invest in other asset classes. Self-directed is a perfect name for the classification because it's giving you control. That's really what it's about, is control of those retirement vehicles instead of just being isolated to investing in stocks, mutual funds, bonds, what have you, to invest in other asset classes like real estate. Anyone that's investing in real estate should know that there's many different advantages to real estate and using leverage over time. I mean, when we talk about rental real estate, yes, we know houses are appreciating, but there's so many other benefits. I mean, we obviously have passive income through cash flow. You also have the tenant, paying your loan down for you. Essentially, you're building equity over time. You're using leverage to stretch your capital further, and then you come with all these additional tax benefits. There's nothing else out there that compares to real estate. But going back to the retirement vehicle aspect of things, once you change the classification of your retirement vehicle to, say, a self-directed IRA, this allows you to invest in real estate and other assets and have some control. You still have that tax benefit under that classification, but there's certain things you need to be aware of and certain regulations. You need to use non-recourse lending, which means you're not personally liable. So it's actually a safer loan because it's just isolated to that particular property. But with that, there's different loan parameters. You potentially might need a little bit more money down. With non-recourse lending, different varying interest rates. And that's why it's important to really work with professionals to see what all your options are, but allows you to scale up using another, really, in my opinion, a retirement account is just another resource for you to scale up your portfolio. And this is something just like equity in a house. If someone wants to pull out a HELOC or use equity in their house to then reinvest in other properties, which many people have a lot of equity that's just stagnant, sitting in their property right now, not because there is such a thing as return on equity. And if your equity is just being, sitting there not earning you a return, then your return on equity would be zero. But with a self-directed IRA, you can take your retirement vehicle, be proactive, and invest in real estate. All the income, I mean, there's certain things to be aware of that we would walk you through, or any professional in the space, to show you that your income needs to go back into the account, and certain things like that. But it's an exceptional opportunity, still applying the same tax benefits to invest in real estate and grow your portfolio beyond what you'd be able to otherwise.
Yeah, I mean, you at the beginning of this conversation, you mentioned real estate and tax advantages being just beautifully linked together, and this is a good way to come full circle on it. And that it's tough to find. You have the SDIRA, you have the solo 401k, you have opportunity zones, you have a handful of items, vehicles, opportunities in the real estate world that just take that tax advantage to a completely higher degree. But to your point, knowing whenever we, on the kind of Lima One Capital lending side of the fence, when we first created a product for this, this was in 2015, there are a lot of nuances that come with lending to kind of a tax advantaged account versus just a business entity. That this is absolutely not something you should go it alone or try to figure it out on your own, because literally you have to follow the letter of the law. You talked about proceeds, how those get used, has to be a true non-recourse, not a limited recourse. Like, there are a lot of I's that have to be dotted and T's that have to be crossed. But I'm a big believer in utilizing the tax code to its fullest potential.
And that's so true, Dalton. I mean, if we look at Congress, right, you mentioned the point about impending changes potentially. And I mean, yes, the tax code and really legislation will change over time. It's always a dynamic space. However, if we just look at where we've been as a country, real estate has always been a protected place because Congress, and there's a reason why 100% of Congress owns investment real estate, right? And that will continue to be the case. But the government implies certain tax codes to stimulate the economy. They want, that's how they influence the economy is through adjusting different tax codes. So by making it an advantage for real estate investors to participate in real estate and go out and borrow money and do things like this. I mean, that's why the tax code is written the way it is. And you're absolutely correct. You need to have a professional walk you through exactly what all the options and regulations are, so you fully understand what the best option is for you. My two favorite things in real estate tax concerning wise is doing a 1031 exchange and also cost segregation studies. I mean, it's a very real possibility that you can continue to trade up and buy more real estate without ever having to pay capital gains, and you can pass that on in many cases to future generations to build generational wealth and those taxes are forgiven. Cost segregation studies, which is essentially accelerated depreciation, you can, if you're an active investor and qualify as a real estate professional, you can very much wipe out your entire tax burden if you buy enough real estate every single year by taking accelerated depreciation. That's exactly what we do every single year. But you got to be aware of these things and be working with the right people to help you map out that plan.
Yeah, I love it. I love it. And no better person to talk to about that than you, and no better group than Rent to Retirement. So tell the fine listeners of Real Estate of Things how they can get in touch with you.
Yeah, absolutely. If someone is interested to learn more about working with us to purchase turnkey properties, or just wants to have an initial consultation to find out a little bit more about investing in different markets and how we work with each client to help them build their plan, they can simply go to our website. It's renttoretirement.com. That's renttoretirement.com. They can call our 1-800 number, 1-800-311-6781, and reach out. The first thing we want to do with every single person is have a 30-minute consultation, go over your investment goals, criteria, your timeline, talk about the different opportunities available to you. We don't charge clients for anything, by the way. We don't charge people for consultations or any sort of mentorship. We sell properties. We build and renovate turnkey properties, and so our income comes through the sale of those properties. All the advice and education and mentorship is absolutely free. We don't charge that for that at all. So we welcome anyone to reach out to us that would like to learn more.
You do business the honest way. How beautiful and refreshing. I love it. I love it. Hey, Zach, thank you so much for sitting down with me. I really appreciate it.
Thank you so much, Dalton. It's been a pleasure.
Hey, thanks to everybody for listening. Talk soon. Take care.